All right, welcome back. Abiodun Keripe, the Managing Director of Afrinvest Research, is joining me right now via Skype from the Commercial Nerve Center of the country. Hello, Abiodun, and thanks for joining us today. How are you doing?
Hi, Nancy. Thank you for having me.
Hi,
Good to
hi,
be here.
hi. What's happening? It's December 1st, the first day of December. Like I said earlier, I don't think it will be a dirty December. I don't even know what dirty December means, but we saw that trending on social media last year. Whatever it means, I know it may not be a dirty December this year because of the recession and the hardship that Nigerians are facing economically. But speak to me about your assessment of the capital market in the last close to 1 year now. What's happening?
I didn't understand that.
I think that's my
Okay.
phone. Artificial intelligence talking there.
All right, that's fine. It happens. So yeah, I mean, if we look back from the start of the year, we could say that the equities market kicked off on a very positive note amid stronger optimism, propelled, I mean, in part by unattractive fixed income yield in the fixed income market and the hunt for high dividend yielding stocks by investors and portfolio managers, right? This was responsible for the sort of returns we saw in the early part of the year, say January, when the year-to-date return as at January was touching about 10.7%, you know. But since then, the sentiment then changed. Just after January, February, all of the sentiment around COVID-19 and how that is likely to affect the entire world, and the fear that the world was basically going into or facing an existential crisis began to impact how investors view the markets, and not just the capital markets generally, economies all across. We could see, as a result of that concern for the spread of the virus, governments all across the world began to implement different measures, from social distancing to lockdown of economies, something that never really has happened before in the history of the world, basically. I know we had the swan flu back then, but then um, the economies of the world were not disintegrated. Globalization and technology were not disintegrated into trade and finance. And so one really couldn't have seen or captured the magnitude of the impact compared to what we're seeing now. So all of that sentiment began to affect how investors react to the market, and there was a sell-off. If you look at the Nigerian equities market, by April, right, the sell-off was at its peak, and the index dropped to significant low, possibly lost over 26% year to date, negative return, all due to the concern around the virus and investor confidence and all that. And if you look at also the market price, the PE ratio for the market, you could see that by half year, PE ratio was just about 8.1 times compared to about 8.5 times half year of 2019. So while it looked like the market has taken a big hit from the negative reaction on the back of the COVID-19, how it impacted on economies, on crude oil prices, and the economy at large, it then seemed like equities appear to have been resilient somehow by half year. And this resilience would have been supported in part by corporate earnings from some of the major corporate that listed, or major companies that listed on the Nigerian Stock Exchange. Looking at those earnings also, one would have expected that, due to the lockdown and how it would impact on sectors, because trade was basically not happening, manufacturing was almost at a standstill, aside essential services that really had that sort of preference. Even the agriculture sector took a bit of impact. And then, healthcare was an essential services, or is an essential service. And as a result of that, you could see even some of the healthcare companies on the stock exchange began to touch new highs that they've not touched in recent years. So this is just sort of a macro backdrop of how the equities market has performed so far this year. We've seen sentiment from negative sentiment from COVID-19, from lower crude oil price, and then the realization that the Nigerian economy is beginning to face external vulnerability, which to even highlight it, right? The Nigerian economy pre-COVID has actually been very weak. If you recall, we're just recovering from a 2016 recession where growth is still below 2%. When I say growth, I mean economic growth was still below 2%. And then COVID-19 then struck. So which further then exposed the vulnerability of the Nigerian economy. And all of this has a way of affecting investor sentiment. And as a result, the market took a big beating, the way we say informally on the floor. Yeah.
Abiodun, I needed you to give that bit of background. Let's take a look at precisely November, because in November was when we saw the largest daily gain in terms of the all-share index in the history of the Nigerian stock exchange, at least in the last 5 years. There was a circuit breaker that came in, I think in the week of the 13th, if I'm not mistaken. Yes, in the week of the 13th of November, whereby the circuit breaker was used by the management of the exchange, I think at about 5 minutes to 1, that's 12:55 p.m. And we've seen in the month of November, from my own figures, because I had to do my own calculations too, in the month of November, the Nigerian Stock Exchange gained about 14%. That's month to date, yes. So if we're taking a look at year to date, it's close to perhaps like a 30% or so. So how do you think a rebalancing will come this December?
So already, I think I would say we're seeing this sort of rebalancing. When you say rebalancing, I guess you mean a sort of correction, right, in the prices of the shares being traded on the floor of exchange. Already, we're seeing that correction since the past 1 week. That correction began. In fact, since the very day the NSE had to trigger the circuit breaker to sort of calm down the heat in the market, the very next trading session, market began to correct, and that correction still extends. Now, looking as to how this would flow into December, yes, because it will flow into December because on one hand, we had massive liquidity that came into the market in November, right? And which was the primary driver of the bullish reaction we saw in November. All of that liquidity is still somewhere around in the market, and there's still more liquidity out there, both for local investors. And the beautiful thing is, now I touched on local investors, is that if you look at the composition of activity in the market, and while this old sentiment clearly might be tough to even decipher going forward, right? Because we're seeing locals taking up a huge chunk of activity in the market compared to when we had the foreign players being the one controlling activity in the market. We are now seeing locals taking up a huge chunk of activity on the market. For September alone, local transactions put together account for over 70% of trades in the market, which is quite significant and unprecedented in the history of the Nigerian capital market, right? So with this sort of activity, this sort of new development, it then tells you that December might just also be an outlier in terms of what can happen in the market. Yes, the market is cooling off, but there's still liquidity in the market. And I think we have a perfect blend of bargain hunters in the market and portfolio traders, right? So who are looking for bargain opportunities to bargain on. And when you see prices correct to significant low levels, then they will come in again, and then begin to buy up stocks, which will take, prices to new level. But this does not take away the fact that we're still dealing with some sort of challenges in the market, like your previous discussion with your last guest. You touched on the fact that we still have FX illiquidity in the market. There's this sort of FX conundrum we're still dealing with. Crude oil prices is still below, historical high levels, right? Corporate earnings, though they look interesting, particularly for Q3, they look interesting. But all of this other macro environment will still have an overbearing effect on sentiment, right? But because we have liquidity, which is key also. That liquidity then, investors will then sort of focus more on corporate earnings and the fact that some of these companies have been resilient, and then expectation that we're coming into the year end where buying for the sake of dividend yield or dividend returns would then begin to also take a front burner. So it's going to be a mix of it, but I think towards the year end we'll likely begin to see some stronger sentiments or positive sentiments for buying.
Some stronger sentiments positive for buying, even though towards the end of the year, traditionally people try to take out money to spend, also try to take out money to fix some challenges like school fees and all that. So are you saying that perhaps because as we go to, I think we have about 21 days to the end of trade this month. You have 3 more weeks to trade this month for the NSC. So are you saying that, for example, that Nigerians, the feel-good sensation will hold sway? Because normally during this festive season or in December, Nigerians or people are generally happy.
So, I mean, what we've seen also, you're right? We have a mix of players in the market, those who are looking for opportunity to exit, to sort of use the funds to take care of other needs, maybe for the Yuletide spending and some other needs. And also you still have the portfolio investors in the market that are looking for opportunities to bargain on. If you take 2019, for instance, right, towards the tail end of 2019 in December into the first week of January, the market was on steroids. And that was pretty much portfolio investors' activity, right, in the market, trying to take position ahead for the year, particularly for the sake of dividend gains or dividend yield. So that is one key driver that why would have that segment of investors that are looking at exiting, we'll still have a large chunk of them that will want to reposition in the market for the sake of dividend.
The question now is that how do you reposition in this market? Because it seems there's bargain hunting is going on, profit taking is also going on. It seems that value investing is also going on. So it also depends on the kind of investor I am. But how should I position myself right now in the markets? Should I go value investing? Should I go cyclical stocks? Should I go non-cyclical stocks? For the benefit of our viewers, cyclical stocks are companies or stocks of companies that are affected by the economic, weather. So if an economy is not doing well, it will also affect those companies. But for non-cyclical stocks, whether the economy does well or not, those companies will do well. Of course, like utilities, during the lockdown, we bought soap, we must take our bath and all. I'm just using an example so that our viewers will understand what I'm saying. So if I want to go into the market right now, which side should I go to?
Okay, so I would approach this from the perspective of the GDP composition and how the sectors in the GDP in the economy have performed during COVID-19, and as we are emerging from COVID-19 in quotes, how these sectors are also expected to perform. We can see that from Q1, Q2, Q3, there are certain sectors that have been very resilient. Take for instance, financial services. Financial services performance has been quite outstanding. Also is telecoms, right? The performance of the telecoms sector also have been very, very outstanding. And these are sectors that and also agriculture, before I move away, agriculture also, even though in terms of the quantum of the growth is still low single digit. I think the last Q3 GDP number puts it at about 1.6 or 1.8% year on year, while the financial services and telecoms are doing double-digit growth. Those three sectors are sectors that investors should watch out for. They are proving to be non-cyclical sectors, right? Because when the economy was going through a turbulence, they actually took a divergent direction in terms of performance, and they deliver outstanding results, both in terms of even the companies the companies operating in those sectors that are represented on the stock exchange. For instance, MTN, Airtel, and the banking stocks from the top tier banks to the tier 2 banks, all of them, their performance have been quite resilient. And we could look into why that resilience in terms of the performance. But just to answer the question, right? Those are sectors I think investors should be looking
So the
at.
non-cyclical stocks, that's that's where you're gravitating to.
Exactly. And interestingly, these are also stocks that have good history in terms of dividend culture. They have a good dividend culture over the last 5 to 10 years for those of them that have been listed and been operational for over those period of years. Their dividend culture have been very consistent, and expectation is that they would repeat such feat even in 2020, particularly as we progress into towards the end of Q1 of 2021, we begin to see those results and then those announcements around the corporate actions that they intend to pay to investors. So these are sectors, dividend paying stocks, non-cyclical sectors for me are just the safest pick because
and there are a lot of them in the market, really, because if you're talking about the banking stocks, yeah, we have majority of them. You're talking of telecoms, we have MTN and Airtel, and some of those companies are in the top tier companies listed on the exchange. Finally, I want to ask this question. Which stocks do you think have become more mature as a result of the pandemic-induced economy we have right now? I hope you understand my question.
So that's interesting. Which stock has become more mature?
Yes, a bit mature as a result of this pandemic.
So when you say mature,
environment.
Do you mean in terms of the pricing or in terms of how the company is being managed?
In terms of the pricing, in terms of the attractiveness by investors, how are investors looking at it, that perhaps they were not just looking at it before, but the pandemic has made us say, oh, okay. You understand what I mean? Like even the agricultural stocks, for example, Como Oil and Presco PLC, those were companies that were not, but they are posting good returns now because the companies are growing and with the policy of the government. I hope you understand what I mean.
I get what you're saying. So like you just pointed out, agriculture sector, but particularly I think the healthcare sector, right, has sort of become the new baby boy in town, right? Take for instance a stock like Nemet. Year to date, the stock has done 294% return, right? That is whopping. Take also, for instance, Maybaker has done 76%. Fitsin has done probably about 59 or 60%.
Abiodun, I think I have to halt you. You've answered my question. You've just answered it here. So you really understand the question in terms of the healthcare stocks. People are looking at it right now because of what happened or what is happening this year. Thank you very much, Abiodun. Let's chat again sometime, at least before we go home for the holidays, if we can.
All right. Thank you for having me.
But have a pleasant December, you know,
too.
as we started this today. All right, that's the much we can take. I've been speaking with Abiodun Keripe, who is the MD, Afrinvest Research. Thank you all for being a part of the show today. So have a happy December, everyone. I'll see you all tomorrow. Nancy is my name. Bye now.